so let's get started here. We're going to be talking about corporate finance, and what you're going to figure out is that corporate finance is known by many different names. Here's Wally, please, my turn. If you guys want to talk about what beer you're going to drink later, you can do that starting at 12:15. Okay, it's corporate finance, financial management, managerial finance. We use these terms interchangeably, and they all mean the same thing, so don't let that freak you out. Let's talk about the balance sheet model of the firm. So hopefully you guys remember just the slightest inkling of your accounting class that assets is equal to liabilities plus owner's equity. So let's talk about what assets are. They are things that the firm owns and expects to bring economic benefits in the future. The things that the firm owns that they expect will bring them economic benefits in the future. So if you've got a factory, we would call that an asset. If you've got a copyright, that's an asset, and so forth. Then we have liabilities, and that's money that you owe to somebody. Now, it's mostly to investors, but if you've got taxes that you owe, taxes due, things like that, those are also liabilities. So basically any money that you owe people. And then finally we have equity. And equity is an ownership stake. It's a residual claim. What does residual mean?
You sort of own the assets and then you pay the liabilities, what's left is what they get.
So let's go simple here and say leftovers. How about that? So what's left over? Residuals are what's left over after, as she said, you sell all of the assets and you pay off all the liabilities. That was what gives us equity. And if you buy shares in a company, you actually own part of that equity. Okay, any questions so far? Okay, so now we're going to talk about the big three questions that we are trying to answer in corporate finance. And the first question is what long-term assets should be purchased by the firm? What long-term assets should be purchased by the firm? We call that the capital budgeting question. Now note that the word capital shows up in all three of these question names. And so we're going to say this one is capital budgeting. What does that mean? At a company, we're going to find out that the goal is to maximize shareholder wealth. And so I should only be purchasing assets that help me to maximize shareholder wealth. And so that's the capital budgeting decision. Now there's a lot of work that goes into figuring out whether or not these projects are going to maximize shareholder wealth. That all falls under capital budgeting. And then we have the question of how we're going to finance the assets that we're going to purchase. Number one tells us what we should buy. Number two tells us where we're going to get the money. And we can either go out and borrow money from a bank. We could issue bonds, which is another form of borrowing. Both of those are liabilities. Or we could issue additional shares, and that would be using equity to finance those assets. And so we call this the capital structure question. The capital structure question. And I'll tell you that the capital structure, you might want to write this one down. The capital structure is the mix of debt and equity that we use to finance the assets of the firm. The capital structure is the mix of debt and equity that we use to finance the firm. The mix of debt and equity we use to finance the firm. By the way, if I say something 3 times, I think it might be important. Yeah. Okay, very good. And then finally we have, how do we manage the short-term operating cash flows of the firm? By the way, in accounting and finance, when we say short-term, what do we mean?
A year less.
Yeah, a year or less, right? So the 1 year is the breakover between short-term and long-term. Okay, so now this is about the short-term operating cash flows of the firm. So we're talking about things like cash, inventory, accounts receivable, accounts payable. And we call that the working capital management question. We call that the working capital management question. Now, which of these do you think is most important for the firm? You've got a 1 in 3 chance of guessing and getting it right.
Working capital management,
Oh, very good. Why do you think so?
because it's short term and the long term doesn't really matter if the short term doesn't go well.
Damn, she's brilliant. Okay, so here's the trick. My wife and I are planning. Oh, whoo, she's ahead of the curve. I like that. That means that any time that you folks don't know, I can always go to her because she's ahead of the curve. Okay.
Not always.
So back to the story. My wife and I are planning retirement. By the way, this marks the beginning of the second half of my career at MSU. I've got 15 years down, I got 15 years to go. Woohoo! I am on the downhill side. Right? Okay, so we're planning to retire, and we've got all sorts of plans and this, that, and the other. But what happens if today I step out in front of a barrel line bus and get killed?
Free tuition.
Or, oh, for you?
I don't know.
You-
Sorry, I go for a professional.
So you're always ready with an answer, like last time that people are stupid or paying the Wall Street Journal. Maybe reserve some of these. Okay, I don't know where free tuition comes into that whole thing, but if I'm dead, I wouldn't be able to take advantage of it, right? Okay, back to the story. If a barrel line bus hits me, my short term is over. There is no long term. And the same is true for the company. If the company basically runs out of cash and can't pay their bills, then the company dies. What do we call the process of the death of the company?
Bankruptcy.
Yeah, bankruptcy. When you run out of cash to pay your bills, you go bankrupt. And so I think number 3 is the most important, simply because if we don't do it right, there is no need to even talk about number 1 or number 2. Does that make sense? Okay. Any questions? So let's talk about financial managers in the organization. And this is a pretty generic org chart. You guys know about org charts from one of your management classes or whatever. Well, anyway, this is pretty generic, and it's probably a little old-fashioned for what we see today, and I'll explain some of the differences as we go along. But it's always true that at the top are the board of directors. Now, the board of directors are elected by the shareholders. So the shareholders are the owners of the firm, and the owners of the firm always get to make the decisions at the firm. Unfortunately, we've got so many shareholders, we can't always just take a poll of all our shareholders to figure out what they want us to do. And so instead, the shareholders elect this board of directors, and the directors are supposed to work in the interests of the shareholders. And the interest of the shareholders is maximizing their wealth, and we'll talk about why that is here in a bit. Now, there are a couple of jobs of the board of directors, and the biggest among them is to hire, compensate, and fire managers. To hire, compensate, and fire managers. You guys hopefully know what hiring is. That's when you go out and you find the right candidate, you bring them on board, and you have a big welcome party, and then you're into the work world. Compensate, what do you think? What do we talk about with compensation? Yeah, how do we pay them? Now, do you think managers just get a paycheck? No, there's probably going to be some sort of stock options, probably going to be some sort of bonuses. There are going to be goals that they've got to hit. Kind of like we do with our athletic teams here. That, you know, if they win a championship, the coach gets an extra $5,000 or some stuff like that, right? Did you guys know that? Yeah. Yeah. They don't give me bonuses for winning anything, but then again, I don't win anything. So that kind of figures. Okay, so the board of directors are going to hire, compensate, figure out how to pay these people. And by the way that we pay them is going to have some impact on their behavior, which we'll talk about in the second part of this lecture. And then directly above them, or below the board of directors, they say chairman of the board and CEO. These roles do not always go together. I want you to scratch through that chairman of the board right now. Scratch through that chairman of the board. We're going to talk about why those things don't always go together and should not go together, and we'll hit that later on in this lecture. And then below them are the president and chief operating officer, usually the same person, so let's just call that COO. Now let's talk about the difference between a CEO and a COO. The CEO is providing the vision for the company. They're the ones that are out there kind of perusing the market, looking for the opportunities, that sort of thing. And that's a lot of reason why we see CEOs typically don't come from an engineering background, they don't typically come from a finance background, they typically come from more the marketing and sales side because they know the market and they can see the opportunities there. The chief operating officer is more concerned with the day-to-day decisions of operating the company. In other words, making things work and work well. So in my marriage, for instance, my wife is the visionary. It was her idea to go to doctoral school and become professors. It was a great idea. I am more like a COO. I execute. I make the trains run on time. I get things done. And so you'll see there are people, I do not have the skills to be a CEO because I lack the vision. I would make a good COO. Now let's talk about the vice president and chief financial officer. So forget that vice president part. Let's just talk about chief financial officer. This is the highest ranking person at the firm that is concerned with the finance and accounting issues of the firm. So it's the highest ranking officer at the firm that is concerned with accounting and finance only, because of course everybody's concerned with it, right? And then underneath the CFO, things break down into two houses. And the first house is the treasurer, the treasurer's office. And the treasurer is the top pure finance person at the firm. The treasurer is the top pure finance person at the firm. The controller is actually the top accountant at the firm. They're actually the top accountant at the firm. And you may even see the word spelled like this. The original word is, it looks like comptroller, but that's not how you pronounce it because the word is French. Anybody here speak French? No. Okay. So in French, this is I'm sorry. It's controller is how it's pronounced in. My accent's awful. Okay. So that is why we've just switched to calling it controller. So don't let that freak you out. Okay. Now under the treasurer, we have people that are responsible for doing those corporate finance things that we just discussed. For example, the cash manager. Which of those three questions we just talked about do you think the cash manager is most interested in?
Capital management.
Which kind? The working capital management?
Oh, working
Right.
capital
Yeah,
management.
the third. By the way, net working capital, we use interchangeably, right? And it's all current assets minus current liabilities. We'll get to that in a bit. Okay, so the treasurer is over the cash manager, and the credit manager is also concerned with the third question because the credit manager is all about receivables, right? And so when we sell something on credit, we get an accounts receivable instead of getting cash. What's the danger when we extend credit to people? Yeah, these deadbeats won't pay us back. And so it's the job of the credit manager to figure out whether or not the companies they're selling to are deadbeats. By the way, if you offer looser credit terms, do you sell more stuff? Yeah. If you offer tighter credit terms, you sell less stuff. So the credit manager at the firm that I was at last, he was always wanting to give out credit with an eyedropper. And I was a salesman. How do salesmen get paid? Commission. What am I wanting him to do?
Open it up.
Ooh, yeah. Oh, yeah, they're good for it. Don't worry about it, right? By the way, when you go to a car lot to buy a car and you're going to borrow the money, how do they know whether you're good for it or not? Yeah, your credit score, right? It turns out for companies we have something similar called Dun & Bradstreet, or a Dunn's report that you can use to determine whether or not these people have a history of paying their bills or not. Of course, you have to have an expensive subscription to that, and of course that means MSU doesn't have it. Okay. Then we have capital expenditures. What do you think? Capital expenditures. Which question do you think?
Capital budgeting.
Yeah, it's a capital budgeting question. Now, do the people in this group actually come up with the ideas? Absolutely not. These people are the ones who are looking at the ideas that are flowing up to them from the different operating units of the company. And those ideas can come from as low as the bottom people in the firm. I got a great idea from a guy that worked on the shop floor. I'll tell you about that later in the class. But you're going to do an analysis on all those things, and then all of those projects are going to be handed up to the capital expenditures group, and they're going to figure out whether or not this is a good project for the firm to undertake. And then we have financial planning. Financial planning decides where to get the money to buy the things the capital expenditures group approves. Which question are they most concerned with? Yeah, the capital structure question, question number 2. So that's the treasurer's side of the house. Now let's talk about the controller's side of the house. Controller is an accountant, the top accountant at the firm, and underneath them we have the tax manager. Why do you think it's important to have a tax manager? Ashish?
Not get sued.
Not get sued or go to jail. If you guys are under the misguided notion that federal prison is light and easy, even at minimum security, let me know. I'll bring in my buddy who did 7 years, and he ran a Ponzi scheme. He can tell you, yeah, he can tell you how tough it is to be in federal prison. So we love our tax manager. They keep us out of prison. On the other hand, there's a tension here. Does the company want to pay more taxes or less taxes? Yeah, less. And so the job of the tax manager is to figure out how to legally pay the minimum amount of taxes possible. So when you're doing your own taxes, if you don't itemize, you're not going to get to write off your mortgage interest, you're not going to get to write off your charitable deductions and all that. And so you can make choices that legally minimize your tax burden. And that's what we expect out of our tax manager. And if you ever hear of someone saying they have an aggressive tax manager, get away from them. Because what are they doing? They're playing fast and loose, right? If you look at Enron, fast and loose. Okay, then we have the cost accounting manager, and you're like, phew, that's got to be pretty easy, because we know the cost of the raw materials, we know the cost of our labor, blah, 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 blah. And for the variable costs that go into our product, by the way, do you guys know the difference between fixed costs and variable costs? Does anybody not know the difference? Okay, so for the variable costs, pretty easy. The fixed costs, we've got to figure out how to allocate those costs to other things. And so that's where your cost accounting manager comes in. And I was constantly arm wrestling these people because they were constantly trying to throw costs onto me that I felt had nothing to do with the product I was producing. I have no interest at all in whatever it is that you're throwing this money at. And of course, it makes me look worse because it gets subtracted out before they figure my profit. And then we have the financial accounting manager. The financial accounting manager is in charge of producing the annual reports for the firm, the annual financial reports. And by the way, these reports have to be submitted to the Securities and Exchange Commission, which is a branch of the United States government, once every 3 months. And since we've got Sarbanes-Oxley, they have to be signed and attested to by the CEO and the CFO. And if they turn out to be fraudulent, those folks can do prison time. So, do we want a good financial accounting manager? Absolutely we do. Now, they're going to make some tough calls on how to account for things because accounting for things differently can impact the reported earnings of the firm. It can impact the taxes that you pay. And so financial accounting manager is important. I actually knew the financial accounting manager at Goodyear. He was in my MBA class. I actually know him. He's still alive. Now he is at Orlando with Universal, the theme park. Yeah, he's like over all their theme park financials and whatnot. I need to get back in touch with him and get some tickets.
I'm so excited,
Yeah, use your networks, people. Okay, and then finally, we have the Information Systems Manager. If I say Information Systems, what are you thinking about? Yeah, IT. Now, you may say, what in the world is IT doing under the accounting department? Because we use IT for basically everything, right? So it turns out that in the beginning, computers were used by the accounting department. In fact, my mother so she taught for 1 year of high school and she figured out that was for the birds. And then she went to become a bookkeeper at the local stone quarry, which is where you dig out big blocks of limestone to make beautiful buildings like Carrington Hall, I think came out of the same quarry. Back to the story. 1964, and they have just brought in this brand new computer. And the computer fills a room about this size, and there has to be massive air conditioning because the computer creates a huge amount of heat. And this thing's probably about as powerful as your calculator. But in the beginning, they're only using it to write the tickets. If the tickets is how they charge their customers, so it's basically the bills. And then they figure out, oh, by the way, we can track all of our transactions on this computer, and we can actually start to turn out some rough financial statements. And so that's how the information systems wound up being under accounting. It's just a historical thing. Now, you remember I told you that this might not be an exactly modern org chart. And the reason that it's not exactly modern is because most companies now have a chief information officer or a chief technology officer, and perhaps that information systems would be under that person instead of being under accounting. Does that make sense? Okay, any questions so far? Okay, by the way, chapter 1 is a hodgepodge or a potpourri. In other words, it's a bunch of stuff that doesn't necessarily go together. So now we're going to shift gears and we're going to talk about some legal terms. And first we're going to talk about limited versus unlimited liability. If the firm's equity investors, we're talking about the owners, the shareholders, if they are responsible for the debts of the firm, regardless of how much the firm owes, that is unlimited liability. Let me give you an example here. Let's say General Electric is worth $500 billion. I don't know what they're worth. Let's say they're worth $500 billion. Now let's say that they do something extraordinarily stupid and they get sued and they end up owing $750 billion. Those stockholders, even though the firm was only worth $500 billion, they are on the hook for all 750. So in addition to the $500 million that the firm is worth, they'll have to cough up an extra $250 million. If, on the other hand, we have limited liability, the most that the equity investors will ever lose is the amount of their investment in the firm. In other words, so I'll give you an example. I bought 10 shares of GE back in 1998 for $83.75 a piece. So my total investment was $837.50. If GE gets into trouble, they have unlimited liability. I will only lose my initial investment. I'm not going to be on the hook for this extra money that may be beyond the value of the firm. Does that make sense? So which of these would you rather have, limited liability or unlimited liability? Yeah, you really want to have unlimited liability, or limited liability. So let me tell you a story here. I moved to Mississippi. I used to be a professor at the University of Southern Mississippi, and I hired this guy to do my yard. And this guy's name was Mark, and he had a 1976 Toyota pickup truck and a trailer that he bought from the local Future Farmers of America welding class. And he also had a $10,000 Dixon ZTR zero turning radius lawnmower, of which he was extraordinarily proud. This thing was like GPS enabled, heat seeking, I don't know what else. It was amazing. Now, those were basically the assets of the firm. So let's say that all that together is worth about $15,000. Now, Mark is mowing my yard one day, and he is listening to AC/DC because he was rocking out on the lawnmower. He can't hear anything. By the way, it's already loud, right? And then he feels the whole lawnmower shudder. And he's startled. And of course he stops immediately. And he looks and sees blood and fur all over the lawn. What do you think's happened? Something's dead. Very good. Okay, now he looks past the field of fur and blood and sees my neighbor's wife and the 3 little children standing at the edge of the yard. Their mouths are hanging open because Fluffy, the family dog, had escaped and ran straight underneath the mower. And that's what led to all this fur and blood everywhere. By the way, Fluffy didn't make it. Okay, so what do you think? Oh, by the way, I didn't tell you all about Fluffy. Fluffy's real name was Sir Charles Fluffmeister, and he was some sort of championship show dog. He's retired, and he'd been put out to stud, which is a pretty good life for a dog, right? If you don't know what that means, look it up. Okay, so he'd been put out to stud. His market value was around $50,000. Yeah, oh yeah. Okay, so back to the story. Mark says, "Oh, ma'am, I'm so sorry." Do you think sorry's enough?
Not quite.
No. Do you think they're going to accept $50,000 as compensation for the loss of this dog? No, why not? What else are they going to sue for?
Those children are getting
Therapy
therapy.
for the kid.
Therapy for the kids, right? Please. Oh, and I'll tell you what happens in court here in a minute. Okay, so they're definitely going to sue Mark. Now, here's what you need to know about Mississippi, and I assume it's similar in Louisiana. You can tell me, Mr. Taylor, if it's similar in Louisiana. Can you buy off a jury in Louisiana?
I'm not sure.
He hasn't tried yet. Okay. Okay. So in Mississippi, Mississippi's referred to as a judicial hellhole, and you can actually Google judicial hellhole, and Mississippi pops up. Okay. So here's what goes on in Mississippi. You get the best justice money can buy. So what does that mean? You remember those tobacco lawsuits? They all got filed in Mississippi. I wonder why, right? Okay. So here we are, Hattiesburg Courthouse. And this family is suing Mark. And of course, here are my Southern lawyer imitations. I apologize in advance if you are a Southern lawyer and take offense. Okay, so the lawyer for the dog, well, actually the dog's family, right? The lawyer for the dog's family, they're doing their closing arguments, and he says, "Ladies and gentlemen of the jury, certainly you recognize that this dog was no mere dog. This dog was a beloved member of this family, more like a sibling to these poor children than a family pet. In addition to his economic value, undoubtedly, there are pain and suffering here that needs to be compensated. There are damages. We need to compensate them. Ladies and gentlemen of the jury, certainly this pain and suffering is worth $2 million.
Therapy's expensive.
Therapy's expensive. Very good. Which, by the way, tells you that being a therapist might be a good career choice because they get paid a lot. Back to the story. And I don't recommend it because you take other people's...
Southern lawyer sounds more profitable.
What's that?
Southern lawyer sounds more profitable.
Exactly. Especially if you're crooked. Okay, back to the story. And no, I'm telling you, don't be crooked because you end up with federal prison. If you still think that's a good idea, let me know. Okay, back to the story. So, the jury convene, or they go off and do their thing, and they come back. And the foreperson of the jury reads the verdict and says, "We find for the plaintiff and award damages of $2 million. Now, the judge, who sounds suspiciously like the lawyer, says, $2 million? Why, that's excessive. Instead of $2 million, I'm only going to award $1 million. Now, remember how much Mark's company's worth? $15,000. Okay, so Mark goes home, and his wife says, "How was court?" And he said, "We lost." And she says, "How bad?" And he says, $1 million. And she says, "Well, I guess you're going to lose your company." He says, "No, it's worse than that. The lawyer tells me I have unlimited liability, which means not only can they come after the assets of the firm, they can come after our house, they can come after the kids' college fund, they can come after my retirement, they can come after your beloved Suburban," and that's when she breaks down and cries, right? That is the danger of unlimited liability. Okay, I'm going to let you off the hook here. The dog didn't actually die. That story was entirely bullshit. Now, why did I put you through such psychic trauma? What? I actually had a young lady sit on the front row and start crying during the story. I said, "Oh, honey, it's bullshit. Don't worry about it." Okay.
I cried the first time I watched it, but also my dog was hit by a car last fall. So
Yeah.
we were, the trauma is real.
Yeah. Okay, so I grew up on the farm, and so animals just freaking died all the time, right? And so I understand that other people feel more things more deeply. Okay, back to the story. Why did I tell you that awful story? Because you'll be marked for life with the concept that you need limited liability. Would you like to know how to get it? Yeah, and that's what I'm going to do next, is to teach you how to get limited liability. And it comes down to what sort of legal form you choose for your firm. There's more than one way that you can legally organize your business. And we're going to talk about 4 here. Now, there's more than just this, because there are general partnerships and limited partnerships. The things that we're going to talk about here today is a general partnership, and I'll try to remember to tell you how limited is a little different. But we're going to talk about different aspects of these different forms of business, and some have advantages and some have disadvantages, and we're going to see what those are. First of all, let's talk about a sole proprietorship. Can anyone tell me what sole means? One. And a proprietor is?
Person.
A person?
Business owner.
A business owner. So a sole proprietorship is a one-owner company. So a sole proprietor, you say, well, I'm not going to organize myself as a sole proprietor. The trick is, if you don't organize yourself under one of these other ways, you are automatically a sole proprietor. So for example, this winter, we have a little snow. Cliff cancels class because he does that. And you decide you're going to get out and make some money. And so you go out and shovel sidewalks. And you are shoveling in exchange for money. It's not an employment relationship. You're out there as a contractor, basically. You are automatically a sole proprietor. It's the easiest thing in the world to do, and you can do it quite by accident, which is exactly what Mark would have had to have done. What Mark would have had to have done in order for that to have been unlimited liability for him. And so we see that limited liability is not one of the things that you get with a sole proprietorship. It's not one of the things you get with sole proprietorship. And you would think that this means that we don't have many sole proprietorships. But in fact, the sole proprietorship is the most numerous form of business. Why is that? Well, most people that start a business, let's say that you're really good at baking cakes. And you don't have a business education, you don't have a legal education, you're just out there whipping up cakes, people love them, you're making all sorts of money. You are automatically a sole proprietor. And so a bunch of small businesses are sole proprietorships. And all those people have unlimited liability. Now let's talk about double taxation. In order for me to talk about what double taxation means, I need to go down to the last one, the corporation, and we'll talk a little bit about it, then we'll jump back up. At the corporation, the company pays taxes called corporate taxes, and then they turn around and pay dividends to the shareholders, and the shareholders pay taxes on the dividends. This is what we refer to as double taxation. So it's taxed first at the corporate level and then at the investor level. In a sole proprietorship, the profits of the firm are taxed like regular income to the sole proprietor. The profits of the firm are taxed like regular income to the sole proprietor. Okay, so there's not double taxation, so that's an advantage of sole proprietorship. Now, is it easy to transfer ownership of the firm? And you might, so let's talk back about Mark again. Mark has the lawnmower, the trailer, and the pickup truck. We said it was worth $15,000. Is that the full value of Mark's business? No. What else is going on there?
Well, he's making money. So
He's making money. I like that.
he will.
Yeah, goodwill, and we'll not use it in the accounting sense. Well, if you bought his business, you would have $15,000 worth of fair market value of the assets, and everything you paid over and above that would be accounted for as goodwill. The question is, why would people pay more than $15,000 for Mark's business?
Brand image.
Say again?
Brand image.
Yeah, so Mark's brand was Extreme Lawn Care, and I don't know why it was extreme. It's not like he popped wheelies on his mower or anything, but that was his brand. And when we would recommend to other neighbors, like, yeah, Mark does a great job, and they'd say, well, what's the name of his company? And I tell them Extreme Lawn Care. Now, most people that hire someone else to do their grass cutting aren't actually there when the people show up. And so what if someone were to come by and offer Mark money, they could take over his route, and as long as they maintained his same quality standards, people wouldn't care, right? And so that brand image that he's built up has some value. Now, my question to you is, do you think that most small business owners have any idea what their company's truly worth? No, they don't. And so they have to typically go to someone who's called a business broker. In order to get the full value of the firm, they're going to have to go to a business broker, and the business broker might say, Mark, you know, your company's actually worth $100,000. Now, by the way, how do brokers get paid? Commissions. Real estate commissions, 6% in Missouri. What do you think business commissions are if you sell a business? 10%. So Mark's going to have to pay this guy $10,000 if he manages to sell his business. However, Mark is still better off because he's got $90,000 in his hand versus the $15,000 he would have had. Does that make sense? And so he's $75,000 better off. Now, here's the next problem. How easy is it, do you think it is to get someone that wants to buy a lawn mowing business in Hattiesburg, Mississippi? You think those people are just falling out of the sky? No. And so this is why it's not easy to transfer the ownership and get the full value of the equity, because you have to go out there and put, the broker goes out and tries to put buyers and sellers together. A little allergy trouble today. Okay, so that's why this ownership transfer isn't necessarily easy. And I would almost guarantee you that the great majority of small business owners that you know have no idea what their business is truly worth. If you start asking them, they're going to tell you what they invested in the different assets, but they don't know what the overall value of that enterprise is. Okay, then the next thing we'll talk about is perpetual succession. Perpetual means goes on forever. Perpetual means goes on forever. And so if a company has perpetual succession, that's basically saying that this company legally, in theory, could go on forever. And we're going to see there's only really one of these that has that. It's not the sole proprietorship, though, because the sole proprietorship ceases to exist when, any ideas?
The owner dies.
Yeah, when the owner dies. By the way, if no one has shared this shocking truth with you yet, we are all going to die. Barring some supernatural event, we are all going to die. And so all sole proprietorships eventually come to an end. Now, what if the owner leaves the firm to his child? It becomes a new sole proprietorship underneath the kid. Does that make sense? Okay. So it's over when the owner dies. Now let's talk about easy capital raising. So let me tell you about a guy that actually I worked with here, and he was my student here, and he was going to open up a new landscaping business. And he went down to the bank and told the loan officer, I have a dream. And the loan officer says, tell me your dream. He says, I want to have the best landscaping business in Springfield. And the loan officer said, that's a great dream. He says, what do you need in order to get this dream moving? And he said, I need a $10,000 Dixon zero-turn radius, infrared heat-seeking, GPS-enabled mower, and I've already got the truck and the trailer. And the loan officer said, wow. He says, that's good. You've already got that figured out. He says, by the way, how much money do you already have? And my student said, nothing. Right? He's got nothing. Would you loan money to someone who could not put their own money into the enterprise? No, definitely not. Why? Why do you think they make you put 20% down on a house? Oh my goodness, let's do a little basic business instinct, behavioral instinct here. If you don't have any of your own money in something and things go wrong, what do you do?
Don't care.
Yeah, you don't care. You just walk away, right? Does that make sense? Okay, so so in order to get these people to have some skin in the game, we call it, we make sure that they pay for part of the asset. And so the loan officer was probably expecting him to have $2,000 or $3,000 to put, and we call it putting money down on the lawnmower. In that case, if he defaulted on the loan, he would lose some money, and that would encourage him to keep making the payments. Does that make sense? Okay, so it's not easy for such firms to raise capital because they're small. The assets of the firm, or the wealth that's involved here, is limited to the owner, right? The equity is limited to one owner. And my student didn't have any wealth. And so it was really hard for him to go out and raise capital. By the way, can a sole proprietor sell shares in their company? No. So there's no way for him to get external equity either. And so really their only choice is to go to the bank and get the money. Or after my student got turned down, he went to the lawnmower dealership. And he walked in there and he was looking at the Dixon Zero Turn infrared heat-seeking GPS-enabled mower, and he was standing there and tears were streaming down his cheeks. And the salesman comes up and says, "Son, what's wrong?" He said, "I wanted to buy this mower to start my business, but the bank told me no." What do you think the salesman says next?
You can finance it.
You can finance it! Now, why would the business be willing to finance him when the bank was not? What's the business getting out of this other than perhaps interest and principal back?
They can take the asset back.
Okay, well, the bank could do that because of repo, right? Wouldn't you love to be a lawnmower repo person? Talk about your low-speed chase. Why is the business interested in loaning them money when the bank would not? What else do they get out of it? Why do we sell stuff? To make a profit. If you don't know that, you need to get out of business school, right? We sell stuff to make a profit. And so the business is not only getting the interest in the principal, they're also getting the profit. And by the way, what's the sales guy getting? Commission, right? All the interests are aligned. Now, the financing is probably going to be more expensive at the dealership than it would have been through the bank. But of course, he couldn't get the financing from the bank, so after all, now he has to go with this. And so that's why we see it's extraordinarily difficult for these folks to raise capital. But is it easy to start? Yeah, it's as easy as falling off a log, right? Remember, I told you could just go out and immediately create a small proprietorship and not even realize that you've done it. Questions? Okay. Now let's talk about partnerships. Any idea what the big difference between partnerships and sole proprietorships are?
More than one person.
Yeah, more than one person in a partnership. My sister is in a partnership. She owns 1/4 of a firm. So there are now 4 owners, let's say. It could be as few as 2, but let's talk about 4. Now, if it is a general partnership, they still have unlimited liability. And here's where you figure out that it pays to get into business with people who are of similar wealth to you. So, I'm 51, I've been working for a long time, I have some money, and how old are you, Mr. Unsley? 20. Are you like loaded with cash? No. Okay, so let's assume that we get into a partnership here, and it's 50-50, because I'm a great guy here, 50-50. And we get into trouble, and there's a huge lawsuit against us, and they say, "Oh, you got to pay $1 million. Do you have $500,000?
I do not.
He does not. Who are they going to come after? Old deep pockets here, right? And so that's why it's dangerous to get into partnerships with people who have different magnitudes of wealth than you do, especially if you're on the rich side. You may end up carrying more of the load if there's a problem down the road. By the way, do you think the same might be true for marriage? Just telling you, marriage is a partnership, right? So if you think about it, your friends, I had a friend that married a young lady. He was poor. He married a young lady whose father was wealthy. What kind of life did she expect? A good one, the same kind that Dad had provided her. and he wasn't able to do that. Okay. Let's see, we were talking about partnerships. They still have unlimited liability, but they don't have double taxation. And so the profits from the partnership get divided up amongst the partners, and then they all pay regular income tax on those profits. Now, when I say regular income tax, I'm not talking about, there's also this thing called self-employment tax. So when I work for the university, I'm paying, I think it's like 7.5% to Social Security. The university is paying an additional 7.5% on my behalf. If you're self-employed, guess what? Yeah, you're on the tab for 15%, right? Okay. Now, so there's no double taxation there. It's not easy to transfer ownership, and in fact, it might be a little more difficult because there's more than one person involved. So, Mr. Jaquez and I decided to go into business, and I'm 51 and you are 49. You look extraordinarily youthful. I'm going to pick someone who's not going to bullshit about it.
90% into the business.
No, I'm 51 years old, and you are
22.
22, okay. So, I plan, so no matter how you're lying to me, we'll go ahead and assume you're 22. Okay, so, how many more years do you think I expect to work? In fact, I think I told you earlier today. 15, right? I plan to work 15 more years. You and I have this great business, and then after 15 years, I'm like, Mr. Jaquez, I'm done. I want to sell the business. And you say, wait a minute, I'm only 37 years old. I've got kids, I've got a wife, I've got a mortgage. I want a lake house, right? Is he going to be interested in selling? No. So we're going to be at an impasse there. And so it's even harder to transfer ownership because you've got to get people to agree. Is there perpetual succession at the partnership? No. In fact, it's even worse than a sole proprietorship. Because sole proprietorship, 100% of the owners have to pass on. Only one partner passes on, and the partnership as a legal entity is done, right? And so you have to form a new partnership at that point. Now, is it easy to raise capital? It's not, but it's easier than a sole proprietorship. Any idea why?
There's more than one credit.
Yeah, you got more than one person's wealth, right? And so let's go back to Mr. Umfleet and I. If we go down to the bank and we are going to co-sign on this loan, if something happens to me, what's the expectation? He'll continue to make the payments. But if it's just me on the loan and I die, there's a good chance that they won't get paid. Additionally, we've got two people's wealth here now instead of just one. And so we've got more equity to start out with. Does that make sense? Okay, so it's a little easier to raise capital, but it's still not terribly easy. Is it easy to start one of these things? It's easy, but it's not as easy as starting a sole proprietorship. And here's why. You're going to have to write down the rules of the road for the partnership, because otherwise what happens at the end, people always claim that they were entitled to more than they actually were. And so what you've got to do is put together what you've decided upon into a partnership agreement. Now, you want this partnership agreement to hold up in court, so who do we have to get involved in writing it? A lawyer. Are lawyers cheap? No. And so you got to find a lawyer, you got to get this written up, and you're actually going to have to hammer out the agreement. And so all that goes into making this a more difficult thing to do.
Excuse me.
Yeah.
So, talking about partnership, in case in an event of death of any of the partners, can his or her daughter or son take over?
Very good. Okay, so let's assume that we've got 4 partners, and one of them passes on. In that partner's will, they can leave the interest of the partner, leave their interest in the partnership to a child, and that child can inherit. However, it now will have to be a new partnership, because as soon as one person in there passes on, the partnership as a legal entity is gone. Does that make sense? Yeah. Okay. Let's see. Let's talk about limited liability companies. Now, this is the hardest question I'm going to ask you all day. Do you think a limited liability company has limited liability? Yes, it's in the name, right? It's in the name. So, the most that you ever lose as an equity investor in a limited liability company is your equity investment. You're not going to lose beyond that. So this is the first one we see that has that protection. That's the first one we see that has that protection. Now, let's talk about what limited liability looks like. So here we have a sole proprietorship, and here we have partnership. And you can think of these things as cakes. So the cake here has more than one owner, the cake here has one owner, but if I can put some icing on top of this thing, I can turn either one of them into an LLC, limited liability company. And so a limited liability company could have one owner, it could have multiple owners. And other than the limited liability portion of it, everything else would be exactly the same. And so basically, you're just losing that limited liability. Do you think losing the unlimited liability, do you think it's valuable to have limited liability? Yeah! If it's valuable, certainly it must cost a lot and be difficult to do. It's not true. I have my own LLC. I haven't figured out what I'm going to do with it, but I have one. And how much did it cost me? $50. And how did I do it? I went to the Missouri Secretary of State website. Okay, I think the robot's lost its mind. Okay, she's back. Okay, so by the way, something I learned in manufacturing, all the robots had girls' names. I have no idea why. Weird stuff. Back to the story. What was I talking about?
Your LLC.
Your LLC.
filing.
Oh, yeah, my LLC. Oh, so I go to the Missouri Secretary of State's website, and all I have to have is my name and my address and an email address where they can contact me. That's it. Right? $50 on my credit card. Bada bing, bada boom. I have, lifted unlimited liability from myself. Does that sound cool? Yeah. Okay, now, I'm giving this talk to a group of Chinese EMBA students, and I think they were actually all lawyers. Oh yeah, they were a lot of fun. Argue about everything. Okay, so back to the story. They said, certainly no one would be stupid enough to do a sole proprietorship when it's so easy to get rid of unlimited liability. I said, no, in fact, most businesses in the U.S. are sole proprietorships. And they're like, you're lying to us, it can't be true. Luckily, just about that time, there was a knock at my door. And it was one of my former students, a guy named Nick. He was my first semester here, so it tells you 2007, right? He came in and he says, oh, can I join in? And I said, sure. He pulled up a chair. And I said, what have you been up to? He says, I have opened a store. He was from some islands, and he was going to sell native stuff from his islands to fellow islanders from there who are in the U.S. working. And he was all excited about it, and he was telling me all about his store. And I said, let me ask you a question. Are you a sole proprietor? And then all the color drained from his face. He says, yes! He had been so excited about starting the business that he had forgotten to take the simple step of LLC. And after he left, my Chinese said, well, maybe Americans are that stupid. It's not just Americans, it's everyone that's excited about starting a business and has no idea how the law works, right? Okay.
Excuse me, sir.
Yeah.
So, talking about LLC and sole proprietorship. In an event where somebody who has LLC runs into trouble, so who gets the unlimited liability?
Ah, okay. So it's the liability of the owners of the firm, if they have unlimited liability, extends to the entire amount owed. But if they have limited liability, it only extends to how much that they have invested. So the question is, you're asking is, who loses here? the person that won the lawsuit, right? Instead of getting the full amount, they can only get the value of the liquidated firm. Does that make sense? Yeah. Yep. Okay, other questions? Okay, let's move on to corporations. Undoubtedly, and by the way, this is a question that people get wrong on exams all the time. What is the most numerous type of business in the U.S.? And everyone answers corporation, when in truth it's sole proprietorship. Now, why do they say that? Because you guys are so familiar with corporations. Tesla, Coca-Cola, I could just keep naming them, right? And you guys know those are all corporations, and you see and hear about them all the time. Do you see and hear about all of the multiple sole proprietorships there are? No, right? So that's why we see corporations are actually the least numerous type of these businesses. Now, the good news is for a corporation, it also has limited liability, meaning that they're not going to lose more than their initial equity investment. And so as a shareholder, what does that mean? It means your stock price can never go below zero. Stock prices can never go below zero because of limited liability. If you had unlimited liability, in theory, stock prices could go negative, and you'd have to actually pay someone to take the stock off your hand. Okay. Double taxation, yes, we talked about this earlier. There's corporate taxes and there are dividend taxes, and when you put both of those together, they easily exceed, usually, the regular income tax that a sole proprietor or an LLC type organization would pay. And so there is a tax disadvantage to being a corporation. There is a tax disadvantage to being a corporation. And so far, it sounds like we could get all the good stuff and none of the bad stuff if we do an LLC. Well, let's start talking about some of the benefits that come along with being a corporation. First of all, it's easy to transfer ownership. Remember earlier I told you about my 10 shares of GE? If I get angry at how GE is doing business and I decide I don't want to be an owner of GE anymore, what can I do?
Sell your shares.
I can just sell my shares, right? Sell my shares and get out from underneath it. Does that make sense? Okay. I can't do that with my sole proprietorship. So this is the easiest transfer at all. By the way, how do I sell my shares? How do you sell your shares of stock in a company? Oh my goodness. Mr. Sadai.
You're asking how do we sell?
Hey, so let's say you've got 10 shares of General Electric. How do you sell it?
I just trade.
You trade. He's using his thumbs. So when my generation says you trade, it's like this.
Yeah,
And when his generation says you trade, it's okay.
Just trade.
Yeah. Yeah. So are you on Robinhood? God bless you. We're going to have to talk.
Yeah, I'm getting out of it. Yeah.
Good. Smart man. Okay, if you're on Robinhood and you don't know why that's an extraordinarily bad idea, come see me. Okay, back to the story. By the way, Robinhood steals from the and gives to the. In this story, you think you are the, but you're actually the. Yeah. Kind of stinks, doesn't it? Okay, back to the story. Oh, where were we at? Oh, so yeah, you just log in to your account, sell your shares. Takes you about what, 3-4 seconds? Yeah, you're a fast thumb typer. Takes you 3, right? Okay, you sell it. Easy. Now, is there perpetual succession? Yes. A corporation can go on forever and ever, except for if two things happen. One, they go bankrupt, right, and get liquidated. Or number two, the owners decide to dissolve the corporation. Those are the two ways that corporations cease to exist. There was actually a Scottish bank that was over 500 years old, would still be in business today if it wasn't for a trader in a back room in Singapore making a bad mistake that totally wiped out the entire equity of the bank. They'd still be around. So theoretically, you could have a corporation that's hundreds of years old. Okay, now, is it easy to raise capital? Absolutely. Corporations, not only can they borrow from banks, and by the way, do you think, let's talk about who's Tim Cook. Tim Cook, do you know who he is? CEO of Apple, right? Tim Cook walks into the same bank where my student was and goes in and says, I'd like to talk to you about borrowing some money. What do you think the difference is in the reception between my student and Tim Cook?
Tim Cook is a well-compensated CEO with Apple having trillions of dollars or whatever.
Yes, and when he walks in, do you think the loan officer looks at him any differently?
I would hope so.
Oh, absolutely.
Yeah.
He's like, Mr. Cook, let me get you brandy and a cigar. We don't allow smoking in here, but for you, I'll make an exception, right? And so they're going to treat him a whole lot better. So it's a whole lot easier for corporations to borrow from banks than it is for sole proprietors or partners. And then, oh, crap. I think we'll be able to go without it from here. So beyond that, they can also issue stock. This is the first of these things that we see where they can actually issue stock. And so they are able to raise what we call external equity. So in not just those 4 initial founders of the company, now they can sell shares to all sorts of people like you and me, and they can raise money in that way. And there's another way that corporations can raise money, and it's called through the issuance of bonds. Bonds in the public debt market. So they can borrow money by selling bonds. Okay. Now, let's talk about why you would have a corporation. Remember, I told you that from a tax standpoint, a corporation stinks. Oh, by the way, we didn't talk about easy to start. The corporation is the hardest up here to start. You have to find a state that you want to incorporate in, typically Delaware or Nevada. By the way, why is Nevada a good place to incorporate? Yeah, well, it has to do with something called reciprocity. They have no reciprocity with the Internal Revenue Service, and so they will not rat you out to the feds because of your dodgy tax dealings. So, what kind of people do you think typically form Nevada corporations? Crooks, right? Okay. So we also, now I'm sure someone will leave a comment on my video that says, I'm not a crook. Yeah, fine, great. I'm sure there are like 3 decent people who have those. Delaware. Delaware is a fly speck of a state, right? Why is Delaware so popular? Because Delaware's laws are friendly to corporations. Other states maybe not so much. And so people will choose to incorporate in Delaware. And in fact, I think Delaware has more corporations than any other state, and even though it's only like this big. Okay, so that you have to sign up with the state to form a corporation, and then there are reporting requirements where you have to report certain things to the state. You don't have that with sole proprietorship for sure. And I sure hope you don't have it with an LLC, because that means I'm behind on my reporting, right? Because I haven't ever told them anything about my business that doesn't exist. You neither. Okay, so we'll go to jail together. Okay, maybe not, because they don't have co-ed jails yet. But we're getting there. Okay, back to the story. So, why on earth would you be willing to jump into this corporation thing, knowing that your taxes are going to be higher and that you've got more government regulation to deal with? By the way, and if you sell your shares publicly, now you've got the SEC all over you too, right? Why in the world would I do that? Any ideas? It has to do with that easy capital raising. If the business is growing so fast that we cannot keep up with that growth through our own wealth and the debt that we can raise through our bank, then it makes sense to maybe go outside. Now, it's like this. Let's think about Facebook back in the day. Mark Zuckerberg and let's call the other guy Frank. And they each own half. And so Mark gets 50 cents of every dollar of profit. Frank gets 50 cents of every dollar of profit. 50-50 split, right? Now, Mark and Frank, they get Facebook together. They realize exactly how narcissistic and vapid people are, that they've got this huge growth possibility, right? But between the two of them and the money they can borrow, they can't grow that thing fast enough. So what do? They start a corporation and they go outside to raise money. Now, at this point, let's assume that they sell off 50% of the corporation. So the outside shareholders have 50%, Mark's got 25%, and Frank has 25%. How is it better for Mark to have 25% than the 50% he originally had? You walk into a pizza shop, and what do they got nailed up on the wall?
The sizes.
Yeah, the different size pizzas. Now, my question to you is it better to have half of a small pizza or 1/4 of the extra large? Yeah, a quarter of the extra large. I'm always amazed when I walk into pizza restaurants and I'm standing there and the person in front of me is like, how many pieces are on that? It's a medium pizza. They're like, how many pieces? I'm like, it's this big. We can cut it into as many pieces as you want, right? It doesn't matter. Okay. So the point here is that 25% of the big pizza is more than 50% of the small. That's why you're willing to go out there and become a corporation, because you've got to go outside to raise enough capital to be able to keep up with the growth, and afterwards your stake, even though percentage-wise is diminished, will actually be worth more money. Does that make sense? Okay. Any questions about what we've been talking about that used to be on the screen? If you were going to have, if you've got a successful company and it's not growing like crazy, which of those should you stick with? LLC. By the way, can you switch from being a sole proprietor to being an LLC? Absolutely. Easy to do. Can you switch from being an LLC to being a corporation? Absolutely. You just fill out the paperwork, right? And could you actually go from being a corporation to being an LLC? Absolutely, because you could do a going private transaction where you buy up the stock out on the market and become an LLC again. And that happens. That happens all the time through private equity transactions. So let's get after this. So what do we care about in finance? We care about cash flows. Why are we caring about cash flows? What do we need to pay our bills? Cash. Can you pay bills with accounts receivable? No. Can you pay bills with inventory? No. And so we really have to have cash in order to be able to pay our bills. And as we discussed last time, if you don't pay your bills, what happens? Starts with a B. Mr. Savannah? Bankruptcy. Thank you very much. Okay. So that's why cash flows are so important to us. And so we're interested in two things. Number one, the identification of cash flows, and number two, the timing. Let's start with identification of cash flows. Do I have any accountants in the room? Okay, good. I'm not going to insult anybody then. So accountants have some weird thoughts. They talk about net income and they act like that's cash, but is it? No, it's not cash because it's got depreciation subtracted out. What the hell? It's got depreciation subtracted out, and it's got so all sorts of non-cash stuff in it. And it also has sales that you made on accounts receivable, so those are not cash receipts, right? You don't have the cash yet. And they also have costs that are still accounts payable, so you don't have any cash that flowed out from that yet. And so net income, you can actually have a positive net income and go bankrupt. Because what if all your sales are bringing you accounts receivable, but all your suppliers require cash? You could be in a world of hurt. So we're interested in identification of cash flows, and a lot of times what we end up doing is having to back those cash flows out of accounting numbers. And that's one of the things that we cover in Chapter 2 that you're supposed to have learned in Finance 8600 and all your accounting classes before you came here. But if you haven't, I have kindly provided you with the video to teach you how to do that. The second thing is the timing of cash flows. And the timing of cash flows is important for at least two reasons. Any ideas?
The time value of money.
Yeah, time value of money. We all know that $1 today is worth more than $1 a year from now, especially now that we have 8% inflation, right? And so definitely the timing is important for the time value of money. But there is one other important reason timing is important. Can anyone guess what that is? So current assets, current liabilities. We talk about current assets being things that are going to bring us cash within a year, and current liabilities are going to be things that require cash within a year. And so if my current assets are greater than my current liabilities, I might feel that I was okay. But what if my current liabilities were coming due in 6 months, and I wasn't actually going to have the cash until 9 months? Then I've got a problem. And so the timing of cash flows is also important for the fact that we just need cash at certain times to do certain things. Questions? Okay. Now let's talk about the goal of financial management. This is something that's getting obscured even now among people who are previously good financial thinkers. Let's talk about these different things. Number one, first of all, who are my marketing people here? Okay, so quite a few of you. Should we be looking to beat our competition / maximize our sales and or market share? Is that what we should be focused on? When I used to work in industry, and I would see the accounting guys, the marketing guys hanging out at the water cooler, they'd say things like, "Hey man, did you see the market share numbers for last month? They were off the charts, man." And then they like high five each other. That's not dignified. Okay, back to the story. And so they would really get hot over that. But here's the problem. You can chase market share and drive yourself into a hole. How could you do that? What's one way to increase your market share?
Undercut the competition.
And how are we going to do that? We have to lower our...
Lower our margins.
Lower your price, and that leads to lower profits unless you can also cut your costs. One example there, Costco keeps the price of that ridiculous hot dog at what, $1.50? And their margins kept going. So what did they eventually do? They cut their costs by cutting out Hebrew National, and they came up with their own hot dog plant. So now those hot dogs are manufactured in their own plant. Most people don't manage to cut their costs like that. And so a cautionary tale is a company called General Motors. Are you guys familiar with the General Motors? Yeah. And so if you roll back in time to the early 1970s, General Motors was on top of the world. And then there was this little thing called the Arab oil embargo, and the price of gasoline went through the roof. And General Motors is making cars with 455 cubic inch engines that get like 4 miles to the gallon. And I remember gas when it was 45 cents a gallon, and my dad had a 400 cubic inch engine in his Ford, and we were just driving around. You could just hear the sucking noise as you drove, right? But then 1973 happens. What do you think happened to gasoline prices? They went up, right? And so and I remember 1979, when gasoline went over $1 a gallon, we thought the end was coming, right? We thought that was the end times, right? But back to the story. Do you think General Motors was in a good position to weather that storm? No. They had been manufacturing, and then basically after World War II, the U.S. had been the chief industrial power in the world because all the other people like Germany and Japan had had their industry destroyed. We were the only untouched nation. And so we cruised for a long time on that. So we cruised into this oil crisis, 1973. Toyota, on the other hand, has been making small, fuel-efficient cars that are actually reliable. It's just an amazing concept, right? And so Toyota, and back then it was called Datsun, now it's called Nissan, they start to import cars into the United States. The cars are cheaper, they're more reliable, and Americans eventually gave up their jingoistic love of the American car and started buying these things. And I knew that the end was coming for General Motors when my dad's hunting buddy Wayne bought a Datsun B210. I'm like, holy crap, that's the end for them, right? Okay, so how does GM respond? Well, GM could have responded by making better cars. They could have responded by making more fuel-efficient cars, right? That would make sense. But what do they do instead? We'll just cut the price to maintain our market share. Fine, but what does it do to profitability? Keeps going down, right? And so it keeps going on and on and on until finally, what happens with General Motors in 2008? Bankruptcy. And in fact, General Motors was down to the point where the money that they made on each car they sold was just enough to cover the health benefits for their retirees, right? Whew. So you can actually destroy yourself by trying to maximize or even just maintain your market share. And by the way, were they even successful? No, they just slowed the decline of their market share. Okay, what about minimizing costs? Minimizing costs. Any of you guys know Jim's Steakhouse here in town? Have you ever been?
Yes.
Is the steak pretty good?
I don't know, I'm allergic to beef.
She's allergic to beef. Oh my goodness. It's horrible? It's horrible.
My aunt got food poisoning
Okay,
from
so
McDonald's.
let's imagine a steakhouse that you enjoy. Or in your case, a chicken house that you... Is there such a thing as a chicken house? I guess Popeyes, right? Okay, back to the story. So, now, let's assume that the owner of this steakhouse is out back smoking a cigarette, because most restaurant people do smoke, and he's out back smoking a cigarette, and a guy pulls up in a truck, and the truck has on the side of it has a horse. And the guy gets out of the truck and he says, "Hey, are you the owner of this place?" And the owner says, "Yeah." He says, "How would you like to pay half price for your meat?" What does the owner say?
I would love to.
"I'm listening," right? And he says, "Well, how can you pull that off?" And the guy says, "We have horse meat." Yeah, we sell horse meat. So sometimes I have to explain to my Chinese students that Americans love horses because
Love to eat.
yeah. We don't eat horses or pets. We just don't, right? So back to the story, and they'll tell me that, you know. So I was actually in China for the Dog Meat Festival. So I'm not like saying stuff that I don't know about, right? I was there. I saw it. Back to the story. Boy, you guys are getting all your cultural competency points today, right? Okay, so. And so then the steakhouse owner says, "Wow, that's a great idea." And so they start buying the horse meat. Now, every place has regulars, and the regulars will come in and they'll order the same thing they always have. And so I order the filet mignon. You guys know what that is? Filet mignon? Okay. And so, but it tastes a little gamey and a little tough. And so I call the owner over and I'm like, "Hey." He's like, "How's everything?" I'm like, "It's great, but the steak is a little off today. It tastes a little different." He says, "That's because we're using horse meat." He says, "In fact, what you're eating is now the filet mignon." Right? Never mind. Okay, so what do? I'm a polite American. I'm going to pay the bill and I'm going to tip, because the waitress was not involved in this debacle, right? But am I going to go back? No. And I saw the same thing happen with Hershey's during the financial crisis. They started substituting vegetable oil for cocoa butter. And you can, if you want to know what cheap chocolate smells like, just walk down the candy aisle during Easter time. And that's all that vegetable oil, nasty chocolate. My wife and I were in the grocery store and I'm like, "I smell cheap chocolate and it's not Easter." And there was a display of Hershey bars. I'm like, "Oh man, they have made a huge mistake, right? If I want cheap chocolate, I'll pay less and get cheap chocolate." Okay, so you can destroy your business by trying to minimize costs. What kind of costs should we be trying to get rid of? How about ones that don't bring value to our customers? We should be trying to get rid of costs that don't bring value to our customers. So, for example, I get razor blades from Amazon.com. And those razor blades come in that awful packaging that they use on the shelf at Walmart to keep people from stealing it, right? You're almost certainly going to get injured trying to open the darn thing, and it's just a real pain. And so what if they instead sell through Amazon, who doesn't have to worry about thievery, sell to them in the frustration-free packaging? It's going to cost less, it's going to be better for the customers, it's a win all around. Those are the kinds of costs we should be looking to get rid of. Now what about maximizing profits? Maximizing profits sounds like a great idea. So let's talk about one way that we can maximize profits. In case you're unfamiliar with accounting in the United States, you must account for you must expense all of your research and development during the year in which it was incurred. Now, I've got it's right there. I've got an iPhone 12 mini, and it came out in 2020, I think. When do you think the R&D was done for that? Yeah, it was done beforehand. And so in those years, Apple was, by the way, geeks are expensive. Apple's paying all these geeks to work on this thing, and they're going to invest millions and millions and millions of dollars. And they're not going to see a single penny of benefit in those years for that investment. And so they could actually maximize their profitability, at least in the short run, by halting R&D expenditures. Now, you guys are probably too young to remember the Motorola Razr, the original. You guys know about the Motorola Razr? Oh my goodness. So everything up until then was, it's like about this size. Maybe I'm exaggerating, but it was awful. And then we saw the Motorola Razr, and I'm like, that's got to be the sexiest phone I have ever seen in my life. But I was unfortunately on a 2-year contract with 1 year left. Right? So finally, a year passes, and I get my Motorola Razr, and everybody wants the Razr. And then, so what do you think were happening for sales at Motorola? Yeah, they're going up. And so, and what's happening to profitability at Motorola? It's going, yeah, it's going up. Oh, come on. So today is the university's emergency drill day. So let's talk about what would happen if we had an active shooter. Do you see any way for us to lock that door? No.
If we don't have the keys, probably not.
Exactly. Do you think they trust me with keys?
They should.
They should, but they don't. This is the first university I've worked at where they wouldn't. I don't even have a key to the departmental office.
Wow.
Yeah, I know. Okay. You do?
We have the key to our office.
I guess I need to take a demotion so I can get a key. Anyway, back to the story. What we'll do is we'll turn the lights off and we'll hide. And I've got 2 or 3 athletes in here. Maybe we'll arm them with heavy things. So just in case someone happens to come in here.
One thing you could do is take a belt or something of that nature, wrap it around the accordion arms on the top there, and that if you stop those, the door can't open.
It's okay. Raise your hand if you're wearing a belt. Very good. So we've got backup, right? Okay. I'm wearing one too, so we're all good. Thank you. That's an excellent tip. Okay, so that's my little safety spiel. So there we go. Okay, now let's talk about what Motorola did. Motorola ceased investing in their R&D. We didn't realize it at the time, but they did. And then their very next phone that came out was spelled, because Razr was like R-A-Z-R. And the next thing they come out with is called the Pebble. Why the Pebble? Because it looks like a rock. Now, one of the great things about the Razr was when you put it in your back pocket, it barely showed. What do you think it looked like when you put the Pebble in your back pocket? Yeah, you got some issues, right? Okay, especially if you try to sit. It's a bad, bad deal. What do you think happened? Do you think the Pebble was a big hit? No. In fact, they might as well call it the Turk, right? Because nobody wanted one. And so, as a result, what happened to the sales at Motorola? What happened to the profit at Motorola?
Down.
What happened to the stock price of Motorola? Went down. In fact, it got so cheap that Google bought the entire company just for the patents, and then separated the patents from the rest of the company and sold the carcass to a Chinese company called Lenovo. You can still buy Motorola phones today. They're not actually Motorola, they're Lenovo phones. But you probably wouldn't buy them if they were called Lenovo because you think Motorola, that's a brand you recognize, right? That's a cautionary tale. They were trying to maximize their profits, and it came back to bite them. Now, what about maintaining steady earnings growth? Which would you prefer? A stock whose earnings growed 3%, 3%, 3%, 3%, 3%, or 2%, 5%, 3%, 9%, 4%, 12%? Which one would you prefer? Yeah, the second one. And so maintaining steady earnings growth, you'll actually hear CEOs say that that's something that they aim for. That is not the goal of financial management. So as you might have guessed, The goal then is to maximize shareholder wealth. Maximize shareholder wealth. Now, for people who are uninitiated in that, in the idea, they might think that, oh, this is a bunch of greedy shareholders and they're just out for their own. Yeah. Okay, so let's talk about why maximizing shareholder wealth actually makes sense from an everyone perspective. Let's talk about the way cash gets handed out at corporations. When a corporation makes money, the first people in line to get that money, whether it's from their operations or a bankruptcy, is the government. What does the government expect? Taxes. And then right behind the government, you're going to find the employees. You're going to find some debt holders with banks, some bond holders, and then you're going to find preferred shareholders, which we'll talk about in Chapter 6. And all the way at the back of the line are the common shareholders. The common shareholders have what we call a residual claim. And remember last time we said residual means leftover. And so these people only get what's left after everybody else gets paid off. Therefore, if I'm making this last person in line rich, what does that mean I've done to every other single entity in this line?
Made rich.
Yeah, I had to have paid them off, right? I had to have paid them what I owed. By the way, everyone else in this line has a fixed claim. The residual claim is the only flexible claim. By the way, when there's a lot of money coming in, it's great to be the shareholder, right? Because you're getting all these sweet, sweet leftovers. Sometimes, though, when times are bad, your leftovers are negative, right? And so that's why we say this common shareholder is that they have the riskiest position at the firm. But they have risked their wealth to make this enterprise possible. They deserve to be compensated, and by the way, if we're making them wealthy, we've already paid everybody else. Does that make sense? Okay. Now, you may hear people say, oh, but what about stakeholders? And this is the argument of the day right now. And that is, we don't just want to think about the shareholders, we want to think about all these people who are stakeholders. Well, what are stakeholders? They're people who might have an interest other than a financial interest in what's going on at the firm. And some of these actually do have a financial interest. We've got the employees. What are the employees interested in? Getting paid is the number one thing, right? And then good working conditions, all that. Then we have our customers. We have suppliers, and we have the government, and I'm also going to add the environment in there. So go ahead and write down environment after government. We'll talk about that. If I don't talk about it, remind me. Okay, let's talk about our employees. If I am maximizing shareholder wealth, I am going to take care of my employees. Let me explain to you what happens if I don't. Let's say, in fact, my accountant comes to me and he says, our labor costs are too high. And he says, you know, what can we do? And I say, hey, I've got an idea. Let's cut everybody's wages in half. Mr. Sadai, what happens?
Not something very good.
Not something very good. Okay, so I have a classroom here, and I've got a bunch of people of different levels of ability and ambition, right? And that's just like the shop floor. I had 31 guys at one point, and I had some that were hard chargers and were doing a great job, and I had others that were slacking off. If I cut wages in half, who's going to leave? The hard chargers. And who am I left with? Yeah, we call it the cream of the crop, right? You're left with the cream of the crop. Now, I've still got half my people left, even though I'm only paying half the money, but they're a bunch of slackers. So, what do? I hire a guy with a whip and a leather suit, and he goes around, and he's like, get back to work, get back to work, get back to work. Now, what do you think happens to my workforce now? They're not happy, and so anyone with half a lick of sense gets out of there, right? And so now who am I left with? Masochists and psychopaths, right? And so now I've really done a bad thing here. Now, let me ask you this question. Was I maximizing shareholder wealth by treating the employees poorly? No. Does that mean I should pay employees way more than they're worth? No. But I should treat them fairly, I should provide good working conditions, I should provide them a fair exchange for what they're giving me. What about customers? This one's easy. What if you treat your customers like crap? Yeah, as long as you're not the only game in town, they're gonna go somewhere else, right? And by the way, when we used to have only one phone company, do you know how the phone companies treated us? Like crap, right? And so now when you talk to the phone company, they treat you slightly less like crap because there are other places you can go, right? Okay, now what about suppliers? What if I treat my suppliers poorly? By the way, typically the way we treat suppliers poorly is by not paying them in a timely manner. That's typical. What if we don't treat our suppliers well? What are they going to do? Yeah, they're going to cut us off. Now, it depends on really the size of your organization. If you are a small business and you are treating your suppliers poorly, it's really easy for them to cut you off. What if you're Walmart? A little more difficult. And in fact, this has been Christmas 1993. I was working in Walmart General Headquarters, and we were doing invoices, or we were paying bills for refrigeration companies, because you know Walmart's got a lot of coolers and stuff. And we would get the bills. And some of the bills said overdue, and they would say that, you know, there was this extra penalty on there. And so I'm just a temporary worker. I hold up my hand and I ask the boss, do we pay the penalty? And he says, no. And he didn't say screw him. He said something else. He said, screw him. We're Walmart. Now, what does that mean? Why can a Walmart get away with that when you, with your small engine repair shop, can't?
They have more power.
Yeah, they've got power in the market, right? So power in the market can be as a supplier or as a customer. If you're the biggest customer, you've got market power. If you're the biggest supplier, you've got market power. Okay. I am sure Walmart doesn't do their business like that anymore. Okay. By the way, we are in a building named after the CEO of Walmart, and we are thankful to their generosity. Okay, back to the story. So don't treat your suppliers bad because they'll cut you off. If they cut you off, you can't sell anything, you can't make a profit. Is that good for the shareholders? No. And then we've got the government. By the way, if you don't pay your taxes, what's the government going to do? They're going to come down on you, right? There's going to be problems. Do you think it's going to be good for shareholder wealth? No. Okay. Oh, by the way, there are many ways for us to say maximize shareholder wealth. I could say maximize the market value of the equity. I could say maximize the share price. I could say maximize the price of the common shares. I could say maximize the market price of the stock. So many ways. But basically, you have to look at each one of those and ask yourself, does that directly correlate to maximizing shareholder wealth? And if it does, then that would be an appropriate answer. I'm telling you this because there will undoubtedly be a multiple choice question. And undoubtedly, the answer will not necessarily be maximize shareholder wealth verbatim. There are many ways to say that. And so you can go back and read your book for some additional ideas on that. Okay, finally, at the end of this, we have the environment. If I don't take care of the environment in the United States, what's going to happen? What's that?
Depends.
It depends.
Sometimes the government regulates that, but also people's opinion.
Okay, so let's roll back to 1969. This is before the Environmental Protection Agency, even before I was born. There was a fire on a river in Ohio. The river was so polluted that someone tossed a cigarette and the river caught fire and it actually burnt the bridges over the Cuyahoga River in Ohio. The locals would call it the Cahoga River, but I'm saying it as it's spelled, Cuyahoga. The very next year, we got Earth Day and we got the Environmental Protection Agency. And now, if you pollute, the EPA comes after you. And I can tell you from my own experience working in industry that they were pretty on top of things. If we were doing something nasty, they were after us. So, and you could look country to country, it's a little different. In fact, they've just recently started implementing environmental protection laws in China. But in the United States, if you don't, you eventually are going to get caught, and you're eventually going to have to pay something. What are they called? Fines. And you might even get sued, and so there's legal judgments. And if you don't believe me, you can watch that movie with Julia Roberts, Aaron Brockovich. You guys ever seen that movie? Yeah. Oh my goodness, my cultural references are all out of touch. Okay, back to the story. You're going to end up spending a lot of money to take care of this problem. And not only are you going to have to pay all the fines and this stuff, but you're going to have to pay to clean this stuff up. Now, let me ask you this. What do you think is cheaper, preventing pollution or cleaning it up? Preventing is much cheaper. And if you don't believe me, I want you to do this example on the way home. I want you to stop at the store, and I want you to buy two 2-liter bottles of Coca-Cola, the sugary stuff, not that diet crap. And I want you to take both of them to your place of residence, and I want you to crack one of them open and pour it down the sink. That is your example of controlling pollution. Now, I want you to take the other one and open it up and pour it on the carpet in your living room. And then I want you to see how hard that is to clean up. Which is better? Yeah. So, by the way, are you ever going to get the cola out of the carpet?
No.
No, you basically have to get rid of the carpet and the padding and then like steam the floor or whatever. Okay, so that's my point to you. It's so much cheaper to prevent pollution and comply with these governmental regulations than it is to be a scofflaw. So you would not be maximizing shareholder wealth if you were violating these environmental protection laws. So it turns out that if we are focused on maximizing shareholder wealth, we will be taking care of all these other concerns. It's good to only give managers one goal. I'm going to give you guys the goal of maximizing your points in the class. I mean, that's kind of unspoken, but that's where we're at, right? Now, what if I told you that I was going to give you 2 goals, and one of those goals was to maximize your points in the class, and the other point, goal, was to minimize your carbon footprint. Doesn't that sound nice? Minimize your carbon footprint. Make you feel virtuous. Minimizing your carbon footprint. Now, how can you do that?
Just buy an offset.
Oh, okay. Well, so you're obviously one of these champagne socialist elites, right? Okay. But what if you don't have cash? What if you're a poor college student, unlike Mr. Green? But, oh, you actually have the name for it, right? Mr.
Yeah.
Green? Yeah. Okay. He's obviously a Green. Okay, back to the story. Howard. So let's ask Robertson? Robinson. Ms. Robinson. Miss. Okay, Miss Robinson. You drive here from Webb City. Do you have to? Do you like ride a bicycle? No. Do you drive an electric car? No. So you're burning gasoline. Is she minimizing her carbon footprint? No. And so now I give you these 2 goals, and next week she doesn't show up. And I email her saying, Ms. Robinson, are you okay? And she says, yeah, I'm just minimizing my carbon footprint, right? People will always jump on the easy one. People will always jump on the easy one. And so that's why, and it's kind of sick, but right now you hear CEOs saying, oh yeah, we need to focus on, and they're like throwing all this stuff up over here. You're like, oh, sustainability, and let's give shoes to kids, and all sorts of other stuff. Like, look, how about this? You make a profit, you pay me the dividend, and I'll buy shoes for kids that I like. Does that make sense? Because after all, whose money is it anyway? It's mine, right? So you'll hear people throwing out these arguments, and managers are buying into it simply because it means that they don't have to deliver on their top job, or should be their only job, which is to maximize shareholder wealth. So be careful buying into these fallacious arguments. By the way, fallacious means of or pertaining to a fallacy. If you thought it meant something else. All right. Questions? I used that word one time in class, and this young lady goes, okay, let's talk about regulation. So we've got publicly traded firms. What does that mean? If you're a publicly traded firm, it means you have stock available out there on the stock market. So if you're a publicly traded firm, you are regulated by the Securities and Exchange Commission. And the Securities and Exchange Commission, by the way, they haven't always been around. They came around after the 1929 stock market crash. Took us like 4 or 5 years to get our stuff together, but finally we get the SEC. And the things that they're asking for are not all that unusual in the beginning. They're saying things like, you have to disclose your pertinent financial information. Wouldn't that be something you would want to know if you were going to invest in a firm? Yeah. And so this is stuff that investors should have been demanding prior to, but back then people invested sort of like they do with Robinhood today, where they don't actually know what's going on. They're just like following the herd, right? Yeah. Yes, Mr. Sadai. Have you deleted the app?
I gotta get my money back.
You got to get your money back. Okay, do that as soon as possible before they totally take it away from you. Back to the story. So they got to disclose all this pertinent financial information. And by the way, they're going to do that in audited financial statements. Why do the financial statements have to be audited? Do you think people will lie about money? People are scumbags, right? They're going to lie. And so we have to have audited financial statements. And we're going to see later on that that doesn't necessarily mean that they're perfect, but it's better than non-audited. And then roll forward in time, we still didn't have the situation where there was a legal responsibility of the officers for those financial statements to be correct. And so then in 2002, after Enron and some other stuff, WorldCom, we came up with the Sarbanes-Oxley Act that says, oh, by the way, the CEO and the CFO have to sign off that these statements are, to the best of their knowledge, correct. And if we find out later that they're not, then the CFO and the CEO go to prison. Do you think that kind of raised the bar? Yeah. In fact, there were a lot of companies that decided to go dark or go private after that just because they didn't want to have to potentially, the CEO and the CFO didn't want to go to prison, right? That makes sense. And by the way, that's good. It cleaned those companies out of the public markets. They're no longer out there for people to invest in. Okay. And then the final thing I want to say about the final regulation is trading on inside information being illegal. What is inside information? So it's private information, and so private information. The CEO's shoe size. Would we care? No. The earnings report for tomorrow. Would we care? Absolutely. So it's not only private information, it has to, and we call it non-public information. And it has to be material, meaning it has to be significant enough that investors would care. Investors would want to know. And so trading on that information is illegal. And the reason it is illegal, who is the victim to that crime? Any ideas?
Shareholders.
Yeah, the other shareholders. I would have sure liked to have known that you guys were going to go bankrupt. I would have sold my shares too. Does that make sense? I was at and I won't name the company here, but I was at a meeting, and it was at the corporate headquarters. And the executive vice president of Umpty Squat, I forget his title, but he comes in, and it's a management training class, and there are 9 of us, and we're all men, or boys at least. And then he says, gentlemen, I can't tell you what the earnings numbers are going to be tomorrow, but I can tell you to buy the stock now. Do you think I bought the stock? Absolutely. Absolutely, Mr. Sadai. Of course I didn't buy the stock, right? By the way, the SEC, what do? They look at trades before and after news events. And if they see unusual trading beforehand, they're going to kind of track you down. And then they're going, and it might have been just pure luck, right? Or pure coincidence. But if they find out that you work for that company, or that your uncle works for that company, or that your grandma, and it could be that you work for the company and the weird trading is happening in your grandma's account. They figure that stuff out. If you don't believe me, ask the people who are doing time in federal prison for doing this. And if you have forgotten how terrible federal prison is, remind me and I'll invite my friend to come talk to you guys about what it's like. Okay. Now, I will tell you one it's not illegal in every country. And so I had a guy in my same doctoral program, and he was from South Korea. And it was not illegal in South Korea. So he went to work for a investment banker. And he had access to all sorts of inside information on mergers and acquisitions. And he was constantly trading on that information through his wife's account, through his mother's account, his grandma, his sister-in-law. He had all sorts of accounts spread out, including his own. And then the Korean government made that activity illegal. And the very next day, my friend turns in his resignation, and now he's back to being a professor. Because it's just not worth it if you can't cheat yourself to riches, right? Okay, now let's talk about complying with regulations. Is it costly? Yeah, so regulations. In order to understand the regulations, what kind of person must we employ?
Regulatory expert.
A regulatory expert is usually going to be some sort of lawyer or accountant. Are these people cheap?
No.
No. They may be cheap in their personal lives, but they're expensive to hire, right? And so we end up having to pay a lot for that. Not only that, there might be opportunities that we could undertake if regulations weren't prohibiting us, or at least creating a gray area where we are concerned that we might wind up running afoul of the government. And so complying with these regulations is costly, and we get back to, there are a lot of firms that simply, after every time we tighten regulations, you'll see this, a lot of firms go private, so they are no longer under those regulations because it was just too costly to get along with it. Now, here's the sick thing. Every one of these regulations gets brought on by an accounting scandal. And after every single one of them, we have greater requirements for accounting. And so what does that mean for employment among accountants after a scandal? It goes up. Can you imagine having a job where you could create your demand for your own product? That's what they've been doing. Okay. Any questions?